Hey, this is not your advisor with NYU Grad. Just a quick disclaimer. This podcast was created by Alphabet and their NotebookLM AI software. Pretty incredible. The output may or may not be 100% accurate in citing the source material. That's just a quick FYI. The AI technology is new, so please use as entertainment, as a starting point for your research and discussion. At the very least, it should give us the flexibility to imagine how this AI technology will be impacting our lives in multiple facets. Hope you enjoy it.
Welcome back, everyone. Today we're doing a deep dive into passive investing and its impact on the market. We're going to be trying to figure out if the stock market is becoming a Ponzi scheme driven by passive inflows.
Sounds interesting.
Yeah, and to help us unpack this question, we've got some interesting sources to go through. We've got some commentary from hedge fund manager David Einhorn.
Oh, okay.
We've got an interesting claim from Michael Green over at Simplify Asset Management.
Okay.
And we've also got this research paper titled, Who Clears the Market When Passive Investors Trade?
All right. I think each of these sources are going to offer some pretty unique perspectives, on the market mechanics and the role of passive investing. So this is going to be interesting.
Yeah, I think so too. I think this paper is going to be particularly helpful in just getting into the weeds of how passive investing actually functions.
Sure.
So let's just jump right in. Let's start with Einhorn. So he's a guy who's been around for a while.
Right.
He's seen a lot of market cycles. What's his take on the current landscape?
Well, Einhorn argues that the rise of passive investing and a decline in regulatory oversight has led to kind of like a distortion in the market. He believes that the decline of active management has reduced price discovery, creating opportunities for companies to manipulate earnings without consequence.
So fewer analysts digging into companies, I guess, meaning less pressure for transparency.
Yeah, that's his argument.
And this shift has led Einhorn to kind of modify his own investment strategy.
Yeah, definitely. So now he's focusing primarily on companies with strong buyback programs.
Oh, that's interesting. Why buybacks?
Well, he sees buybacks as a way to kind of counteract this lack of co-investors in the market. So if a company buys back their shares, it reduces the supply of the shares, which theoretically can help boost the price even without, widespread investor enthusiasm.
So it's a way of sort of manufacturing demand.
Right, exactly.
And Einhorn's experience, especially during the 2008 financial crisis, kind of further solidified his concerns.
Yeah.
He saw how massive redemptions from long-only funds kind of drove down the price of his holdings, even holdings that he felt were thoroughly researched.
Right. So these institutions, these large institutions faced with, waves of redemptions, they were forced to sell, regardless of whether the stock was overvalued or undervalued.
Yeah.
Their decisions were driven by the need to, meet those redemption requests, not necessarily by the fundamentals of the companies they were selling.
Interesting. So that brings us to Michael Green, who takes this idea maybe a step further.
Yeah.
And Green makes a pretty bold statement. He argues that the passive flows are turning the stock market into a giant Ponzi scheme.
Right.
That's quite a statement.
Mm-hmm.
What's the logic behind that argument?
Okay, so Green's argument really hinges on the idea that passive flows create this self-fulfilling prophecy. Rising stock prices attract more passive investment, which further inflates valuations, regardless of the underlying fundamentals.
So the prices go up, more money flows in, prices go up further, and so on.
Precisely. But Green argues that this dynamic becomes really precarious when demographics shift, like when, for example, when baby boomers start to retire en masse and need to withdraw, funds from their index funds.
That's a good point. What happens when that wave of passive inflows reverses?
Yeah, that's exactly what Green's worried about.
Okay.
He sees potential for social and political unrest if this dynamic continues to exacerbate wealth inequality with the potential for a market downturn disproportionately impacting those who rely heavily on passive investing strategies.
It's a sobering thought. So we have, Einhorn's concerns about price discovery being diminished, Green's warning about a Ponzi-like dynamic.
Mm-hmm.
Now let's bring in the academic research. Who clears the market when passive investors trade? This paper offers kind of a data-driven perspective.
Yeah. This research is really interesting. It goes beyond just like anecdotes and theories.
Right.
It actually dives into, the data to understand what's happening kind of beneath the surface.
Yeah. And what did the researchers uncover? Like, who's on the other side of those passive investment flows?
Their findings were pretty surprising, actually. The primary source of shares purchased by passive investors, well, it's not other investors selling their shares, as one might assume. It's actually the companies themselves.
Really? Companies are selling their own stock to passive investors? How does that work?
Yeah. The majority of these shares are being issued through employee stock compensation programs, so things like stock options and restricted stock units.
So as passive investors buy more shares, driving up the prices, companies are incentivized to issue even more stock to compensate their employees. So it's this feedback loop.
Precisely, yeah. And this finding directly connects back to Einhorn's concerns about, distorted incentives. So if companies are the primary sellers to passive investors, are these executives maybe prioritizing short-term stock price gains, just to benefit from their own stock compensation, maybe at the expense of long-term value creation?
That's a crucial question.
Yeah.
So it sounds like this dynamic could create a bit of a conflict of interest.
Yeah, I think so. Yeah. And the research provides some pretty compelling evidence to support that concern, actually. They found that companies are most likely to issue stock when valuations are already high,
Okay.
suggesting that they're capitalizing on this demand from these passive inflows, just to inflate their stock prices and their own compensation packages.
It's fascinating. So it's not just passive investors passively buying, whatever's available. Their actions are influencing the supply of shares in the market, potentially creating an artificial demand.
Right, exactly.
The research also shed some light on the role of short sellers in this whole dynamic. What did they find?
Well, they found that while short sellers do play a role in supplying shares to passive investors, it's not as significant as one might think.
So even though they're often seen as the savvy investors, the ones who can identify
Yeah.
overvalued companies, they're not this counterbalancing force.
Right. And it makes sense when you consider that short selling is inherently risky, right? You're betting on a stock's decline.
Right.
You're limiting your potential upside. And if the market is being driven by these passive inflows, flows that are somewhat insensitive to valuations, it creates a tough environment for short sellers to operate.
It's like trying to fight against the tide. You might make some progress, but it's an uphill battle.
Exactly, a perfect analogy. Now, going back to the question of the Ponzi scheme, the research paper, they don't explicitly use that term. However, the evidence that they present does raise important questions about the sustainability of this feedback loop that we've been talking about.
Yeah, this is where it gets really interesting. The research uncovered a crucial detail about how this relationship between passive investors and companies actually evolves over time. What did they find?
So the study found that this reliance on companies as the primary suppliers actually intensifies over time. So as passive investing grew, this dynamic became even more pronounced.
So as more money flowed into passive investments, companies became even more reliant on issuing stock to meet that demand.
Right.
That seems like a precarious situation.
Precisely.
Yeah.
It raises concerns about the stability of this model, in the long run. The market could become increasingly dependent on companies' willingness to issue more and more stock, which, as we discussed, could be driven by these short-term incentives rather than long-term value creation.
Right. It's like building a house of cards on a foundation of stock options.
Yeah.
Did the research explore if this dynamic played out differently across different industries?
Yeah, they did. They examined if this relationship was consistent across different sectors. And while there were some variations, companies in all industries did exhibit a tendency to increase their share issuance, as a response to this passive buying.
So it's not just, a few high-growth tech companies. It appears to be a broader trend across the market.
Right, exactly. And importantly, they delved into the specific mechanisms, that companies were using to supply these shares, and their findings were actually quite insightful.
So what did they discover?
Well, they found that companies weren't primarily using traditional methods, like secondary offerings to issue these shares. Instead, as we touched upon earlier, the bulk of these issuances were happening through these employee stock compensation programs.
So it's not just companies openly going to the market and selling large blocks of stock to passive investors. It's happening more subtly woven into the fabric of employee compensation.
Exactly. Yeah. These programs are often seen as a way to, align the interests of the employees with those of the shareholders, but as we're seeing, as our discussions highlighted, it can also have these unforeseen and potentially negative consequences.
Yeah, it's a reminder that, even well-intentioned, policies and practices can have unintended outcomes, especially in such a complex system like the stock market.
Yeah. And the researchers also pointed out that, it's not just the quantity of shares being issued, it's the timing of it as well. That's a big part of the concern here.
Hmm.
So they found that companies were particularly likely to issue shares when their valuations were already high.
Right. So that seems to reinforce this conflict of interest, right? That some executives might be, exploiting the demand from these passive inflows just to boost their own compensation by issuing shares at inflated prices.
Exactly. Yeah, it's a case of, short-term gain potentially outweighing long-term value creation. And this finding brings up a pretty important question. Where does this dynamic end? If passive inflows keep pushing valuations higher, and companies keep responding by issuing more stock to capitalize on those valuations, is there a breaking point?
It's the billion-dollar question. Unfortunately, the research doesn't offer a definitive answer.
Right. However, the research does point out a potential blind spot, in our understanding of this whole process. So they point out that their analysis, it primarily focuses on identifying the immediate sources of shares purchased by passive investors. But that may not tell the whole story.
So they're looking at who's directly selling to the passive funds, but there might be more to it.
Right, exactly. Think about it this way. When a large index fund, makes a significant purchase of a company's shares, the seller, on the other side of that trade, they might not be the ultimate source of those shares.
Yeah.
There could be a chain of intermediaries involved.
So it's like tracing the path of a package. You know who delivered it, but you don't know where it originated or all the stops that it made along the way.
Exactly. So, for instance, a hedge fund, might sell shares to the index fund, but that hedge fund might have gotten those shares from another investor, and so on and so forth. So, what the researchers are suggesting is that their data might not be capturing this entire chain of custody for the shares.
And why is that significant?
Well, it raises concerns about about the sustainability of this dynamic in the long term, because we don't really have a clear picture of, how many steps are in that chain.
Right.
Or how willing those intermediaries are going to be, to keep supplying shares as passive investing continues to grow.
So it's possible that there's only a limited pool of investors who are actually willing to sell these shares.
Right.
And that pool might shrink as valuations become more and more detached from fundamentals.
Yeah.
It's like a game of hot potato, and nobody wants to be left holding it when the music stops.
A very apt analogy, yeah. And this is where Green's concerns about a potential Ponzi scheme become particularly relevant. If the market is ultimately relying on this, dwindling number of investors who are willing to sell to these passive funds, it raises serious questions about the stability of the entire system.
Yeah, it's a reminder that even though this research paper gives us, some valuable data and insights, it doesn't paint the full picture.
Yeah.
We need to consider the possibility of hidden vulnerabilities within this complex market ecosystem.
Yeah, absolutely. Yeah, for sure. And the research also acknowledges that that their data only goes up to 2021.
Right.
So it's missing the past couple of years
Yeah.
of activity. So much has happened
Yep.
since then. We've had a surge in inflation, rising interest rates, renewed volatility in the markets. It's possible that that some of these trends that they observed have shifted.
Yeah, so the relationship between passive inflows and company stock issuance might not be as strong.
It's certainly possible. And we've also seen this resurgence of interest in active management,
Oh, interesting.
with investors looking to kind of outperform in
Right.
this more challenging environment. So that could also be influencing the dynamics that we've been discussing.
Makes sense. So while the research provides a framework for understanding, these dynamics, we need to remain adaptable, recognizing that the market's always,
Oh, yeah.
evolving. Things change.
Absolutely. And another point the researchers make is that their analysis is focused on on aggregate level data.
Oh.
So they're looking at overall passive investing flows and company behavior.
So they're looking at the big picture, but there could be variation within specific sectors or companies.
Exactly. Some sectors might be more reliant on companies as these share suppliers than others, and some companies might be more aggressive in using stock-based compensation to kind of juice up their stock prices.
Right. So while the analysis provides these valuable insights into the broader trends, we can't just assume it applies uniformly across the board. It reinforces the importance of really doing our own due diligence and evaluating companies on a case-by-case basis.
Yeah.
And this all kind of boils down to the fundamentals, right?
Yeah.
Understanding a company's business, their management, their financials. Passive investing shouldn't be an excuse to,
For sure.
to skip the homework.
I completely agree. Passive investing, it doesn't absolve us from the responsibility of thinking critically and making our own informed decisions. It's not a magic formula that guarantees success.
No. The researchers also emphasize the need for more research in this area, particularly around the role of these other intermediaries in the market clearing process.
Yeah.
And they mentioned the possibility of hedge funds, for example, acting as intermediaries between passive investors and companies.
Yeah, that's an interesting angle. So a hedge fund could purchase shares from a company, hold them for some time, and then sell them to an index fund. And this could kind of obscure the true source of those shares. It makes it hard to really assess the sustainability of the whole dynamic.
So we're back to that analogy of tracing a package.
Right.
There could be multiple stops along the way.
Yeah.
Making it hard to pinpoint the origin.
Exactly. Exactly. And the researchers are suggesting that, understanding the motivations of these intermediaries is key.
Right.
Are these hedge funds just providing liquidity, or are they exploiting these arbitrage opportunities that are created by this passive investing wave? Better data, more research, could help us answer these questions.
Yeah. Seems like the more we dig into this, the more questions arise. So where do we go from here? What's the takeaway for our listeners? The sophisticated investors who are tuning in.
Well, I think the biggest takeaway is just to be aware, right? Don't just buy into the hype that passive investing is some sort of foolproof path to wealth. Understand the dynamics that we've discussed today. Recognize that companies are often the primary sellers to passive funds, not just other investors.
Right.
Be mindful of the potential conflict of interest that's created by this stock-based compensation.
Right.
And remember that the true sources of these shares might be hidden from view.
It's about being informed, being discerning, not just blindly following the crowd.
Exactly.
Right?
Be prepared to adapt as the market changes. Consider diversifying your portfolio beyond just passive investments. Explore active management or alternative investments that might be less susceptible to these distortions.
Right. And most importantly, stay curious. Keep learning, keep questioning, and keep seeking out that knowledge.
For sure. And the researchers conclude their paper with a pretty powerful message. They're advocating for greater transparency and access to better data in this realm.
That makes perfect sense. If we're going to truly grasp the risks associated with passive investing, I mean, we need a clearer picture of how the market actually works.
Right. We need reliable, timely, and comprehensive data. We need to know who's buying, who's selling, and where those shares come from. We need to understand the motivations driving these trades.
Right.
Are companies issuing stock to actually fuel, growth, or are they just, trying to line their own pockets, so to speak?
Right. Yeah.
Are these hedge funds playing a purely intermediary role, or are they capitalizing on market inefficiencies? These are crucial questions that data can help us answer.
And those answers could profoundly shape how we see the market and influence our investment decisions.
Absolutely. Transparency and robust data are fundamental to making informed decisions and really mitigating these risks.
So for our listeners, let's leave you with this. If companies are the primary sellers to these passive investors, especially through these stock compensation programs, does that create an inherent conflict of interest?
It's a question worth worth considering.
Yeah.
Are executives incentivized to prioritize, short-term stock price gains, over long-term value creation,
Yeah.
simply to benefit from these stock options and grants? It's a complex issue with no easy answers.
Yeah. It really highlights the paradoxical nature
Yeah.
of passive investing. It's designed to be a hands-off approach, tracking the market rather than trying to beat it. But the sheer volume of these passive inflows seems to be, warping things a little,
Yep.
creating distortions,
Yeah.
feedback loops, It's altering the very nature of the market. It's designed to mirror.
Yeah. It really reinforces the fact that no investment strategy, even one labeled passive, is
Oh.
without its consequences.
And those consequences can be quite far-reaching,
Absolutely.
impacting, not just individual portfolios, but potentially the entire market ecosystem. We need to approach passive investing with a critical eye, understanding both its potential benefits and its inherent risks. And hopefully this deep dive, has provided you with the knowledge and the insights to do just that. Keep asking those tough questions. Keep digging deeper and keep challenging your assumptions. That's the path to becoming a more informed and a more discerning investor.
Absolutely. And, it's important to remember that, we're just scratching the surface here. There's a lot more research that needs to be done,
Yeah.
especially on those intermediaries, their motivations and how they operate.
Right. Yeah. Trying to figure out exactly what role they play.
Right.
Well, I think this has been an absolutely fascinating deep dive. I feel like I've learned a lot, and I hope our listeners have too. Passive investing, it's often touted as this simple, set it and forget it approach to investing.
Right.
But as we've seen, there's a lot more complexity beneath the surface.
Absolutely.
And, we need to be aware of these dynamics, to truly make informed decisions.
Yeah, absolutely.
So for our listeners, keep asking those tough questions.
For sure.
Keep digging deeper and keep challenging those assumptions. That's really the key to becoming a more informed and discerning investor.
Couldn't agree more.
Thanks for joining us on this deep dive.
Yeah, this was a good one.